Japan has carried a debt load that would have bankrupted half the planet, and nothing happened. For decades, economists waited for the collapse. It never came. So people stopped asking if the miracle would end. They started believing it couldn't. Here's the problem. It can. And it's happening right now. The myth is simple. Japan discovered some financial cheat code. Print money. Buy your own debt. Keep rates near zero forever. No consequences. No inflation. No crisis. Just infinite runway. The reality? Japan's debt miracle was never magic. It was a fragile deal between three things: a massive pool of domestic savers, rock-bottom interest rates, and a central bank willing to become the buyer of last resort. That deal is breaking, not because of a policy mistake, because the country is shrinking fast. Here's what nobody says out loud. The crisis isn't financial first. It's demographic. Japan is aging out of its own miracle. The savers who funded decades of government borrowing, they're retiring, selling assets, drawing down savings. And when a nation of creditors becomes a nation of spenders, the math gets violent. We're going to break this down into 7 reasons why Japan's debt endgame is no longer a distant theory. It is a countdown already in motion. We'll cover the demographic switch, the vanishing savings pool, the central bank trap, the interest rate butterfly effect, the productivity mirage, the yen pressure valve, and the 3 ugly exits left on the table. By the end, you'll see why the country that rewrote the rules of sovereign debt is about to find out those rules still apply. So, what happens when the miracle runs out of time? Let's start with the part everyone misses. Japan's debt didn't explode because politicians were reckless. It exploded because the people allowed it. For decades, Japanese households were the world's most patient creditors. They saved relentlessly, bought government bonds, kept their money in domestic banks paying near zero interest. And they did it willingly. Why? Because they were young. Because they were building wealth. Because the future felt long. That version of Japan is over. Here's the demographic switch in one sentence. The country that spent 30 years saving is now spending 30 years spending down. The population isn't just aging, it's inverting. By 2050, nearly 40% of Japan will be over 65, verify. The worker-to-retiree ratio is collapsing. Every year, fewer people earn, and more people withdraw. And here's where it gets ugly. Retirees don't buy government bonds. They sell them. They liquidate savings to cover healthcare, living expenses, and the gap between pensions and reality. The same households that funded Japan's borrowing binge for decades are now on the other side of the trade. They're not creditors anymore. They're cash flow problems. Think of it like this. Imagine you're running a Ponzi scheme, but it's legal, and it's called sovereign debt. The scheme works as long as new money keeps coming in. But Japan's new money is retiring. The population pyramid isn't just top-heavy. It's about to tip over. Dryly. Turns out, you can't run a debt-driven economy when the people holding the debt start needing it back. Let that sink in. This isn't a distant problem. Japan's working-age population has been shrinking since the mid-1990s. The savings rate, once among the highest in the world, has collapsed. Household financial assets are still massive, yes, but the flow has reversed. Japan isn't accumulating savings anymore. It's burning through them. So here's the question no one wants to answer. If Japanese households stop being the buyer, who's left? Good question. The answer used to be other Japanese savers, banks, pension funds, insurance companies. Japan's debt was a closed loop, borrowed domestically, held domestically, rolled over domestically. No foreign creditors to spook. No currency risk. No sudden stops. It was the perfect insulation until the pool started leaking. Here's the reality. Japan's household savings rate has gone from around 15% in the 1990s to near zero today, verify. The famous wall of cash that funded decades of deficit spending? It's not growing anymore. It's static. And in some years, it's shrinking. Meanwhile, the government's borrowing needs aren't shrinking. They're accelerating. Aging costs, healthcare, pensions, debt service. Japan needs to issue more bonds every year just to stand still. But the domestic buyers, the patient, captive creditors, are tapped out. Here's the kicker. When households stop saving, someone else has to pick up the slack. In most countries, that someone is foreign investors. But Japan is different. Foreign ownership of Japanese government bonds is still relatively low, around 15%, verify. Why? Because the yields are terrible, the currency is volatile, and the demographic writing has been on the wall for years. So if households won't buy and foreigners won't buy, who does? The central bank. The Bank of Japan now owns over half of all outstanding government bonds. Verify. Let that number land. The central bank isn't a normal buyer. It's the buyer of last resort. It doesn't buy because the bonds are attractive. It buys because no one else will. Think of it like this. You're at an auction, and there's only one bidder. That's not a market. That's a bailout in slow motion. But here's the part nobody says out loud. When the central bank is the dominant buyer, price discovery dies. Yields stop reflecting risk. The market becomes a fiction, and the government can borrow at rates that have nothing to do with the underlying reality of the debt. It works until it doesn't. Because the savings pool isn't just shrinking, it's aging out. The institutions that bought bonds for decades are now managing outflows, not inflows. Pension funds are paying retirees. Insurance companies are paying claims. The domestic bid isn't just weaker, it's structurally turning negative. So here's the question. What happens when the only buyer left is the one printing the money? Let's talk numbers. Japan's debt-to-GDP ratio sits around 260%. Verify. That's not a typo. For every yen of economic output, the government owes 2.5 yen in debt. It's the highest in the developed world by a long shot. Now, most people hear that number and think, okay, but they've been living with it for years. So what's the problem? The problem is interest rates. Here's the thing about massive debt. It's manageable when rates are low. Japan has kept borrowing costs near zero for decades. Debt service, the actual cash needed to pay interest, has stayed weirdly affordable despite the debt pile growing into the stratosphere. As long as rates stay pinned to the floor, the math holds. But here's where it gets ugly. Even a tiny move in rates becomes catastrophic when the debt is this large. Let's say the BOJ raises rates by just 1 percentage point. Sounds harmless, right? On a debt load of over 1,200 trillion yen, that's an extra 12 trillion yen per year in interest costs. That's roughly 2% of GDP just from a 1-point move. Now imagine rates going to 2% or 3%. The numbers turn violent fast. Think of it like this. You're juggling chainsaws and someone just turned up the gravity. The moment the weight increases, everything collapses. This is what economists call the interest rate butterfly. A tiny flutter in rates causes a hurricane in the budget. Japan is trapped in a world where normalizing monetary policy would bankrupt the government. The debt isn't just big, it's exponentially sensitive to any change in the cost of borrowing. And here's the kicker. Japan may not even get to choose when rates rise. If inflation picks up, whether from imported energy costs, a weaker yen, or global commodity shocks, the BOJ might be forced to raise rates just to keep the currency from collapsing. And the moment they do, the debt spiral kicks in. Higher rates mean higher debt costs. Higher debt costs mean more borrowing. More borrowing means more bonds. More bonds mean, you see where this goes. It's a feedback loop designed to eat itself. Now, some people argue, Japan prints its own currency. They can always just print more yen to service the debt. Technically true, but printing money to pay your debts has a name. It's called monetization. And the endgame of monetization isn't stability, it's inflation. Maybe hyperinflation if confidence breaks. So the butterfly isn't just about rates. It's about the impossible choice. Let rates rise and blow up the budget, or keep rates pinned and blow up the currency. Let that sink in. Japan's debt load has become so large that even normal interest rates are abnormal. A 2% rate isn't high, it's deadly. The economy has been rewired around the assumption that free money lasts forever. And when that assumption breaks, the whole structure comes down. So here's the next question. If the debt math is this fragile, what about the actual economy holding it all up? Let's talk numbers. Japan's debt-to-GDP ratio sits around 260%. Verify. That's not a typo. For every yen of economic output, the government owes 2.5 yen in debt. It's the highest in the developed world by a long shot. Now, most people hear that number and think, okay, but they've been living with it for years. So what's the problem? The problem is interest rates. Here's the thing about massive debt. It's manageable when rates are low. Japan has kept borrowing costs near zero for decades. Debt service, the actual cash needed to pay interest, has stayed weirdly affordable despite the debt pile growing into the stratosphere. As long as rates stay pinned to the floor, the math holds. But here's where it gets ugly. Even a tiny move in rates becomes catastrophic when the debt is this large. Let's say the BOJ raises rates by just 1 percentage point. Sounds harmless, right? On a debt load of over 1,200 trillion yen, that's an extra 12 trillion yen per year in interest costs. That's roughly 2% of GDP just from a 1-point move. Now imagine rates going to 2% or 3%. The numbers turn violent fast. Think of it like this. You're juggling chainsaws and someone just turned up the gravity. The moment the weight increases, everything collapses. This is what economists call the interest rate butterfly. A tiny flutter in rates causes a hurricane in the budget. Japan is trapped in a world where normalizing monetary policy would bankrupt the government. The debt isn't just big, it's exponentially sensitive to any change in the cost of borrowing. And here's the kicker. Japan may not even get to choose when rates rise. If inflation picks up, whether from imported energy costs, a weaker yen, or global commodity shocks, the BOJ might be forced to raise rates just to keep the currency from collapsing. And the moment they do, the debt spiral kicks in. Higher rates mean higher debt costs. Higher debt costs mean more borrowing. More borrowing means more bonds. More bonds mean, you see where this goes. It's a feedback loop designed to eat itself. Now, some people argue, Japan prints its own currency. They can always just print more yen to service the debt. Technically true, but printing money to pay your debts has a name. It's called monetization. And the endgame of monetization isn't stability, it's inflation. Maybe hyperinflation if confidence breaks. So the butterfly isn't just about rates. It's about the impossible choice. Let rates rise and blow up the budget. Or keep rates pinned and blow up the currency. Let that sink in. Japan's debt load has become so large that even normal interest rates are abnormal. A 2% rate isn't high, it's deadly. The economy has been rewired around the assumption that free money lasts forever. And when that assumption breaks, the whole structure comes down. So here's the next question. If the debt math is this fragile, what about the actual economy holding it all up? Here's the part that doesn't make the headlines. Japan isn't just aging, it's shrinking. The population has been in decline since 2008. Every year, there are fewer workers, fewer consumers, fewer taxpayers. The economy isn't stagnant, it's contracting in slow motion. And here's the thing about a shrinking economy. It doesn't just mean less growth. It means the entire fiscal model breaks. Tax revenues fall. Spending needs rise. The ratio between what the government collects and what it owes gets worse every single year. But wait, you might say, Japan is still rich. It's still one of the largest economies in the world. GDP per capita is high. Living standards are solid. So what's the problem? The problem is that wealth and productivity aren't the same thing. Japan's wealth is stored. It's in real estate, financial assets, corporate balance sheets, and decades of accumulated capital. But productivity, the ability to generate new value, new income, new growth, is stalling. Labor productivity growth in Japan has been anemic for years. The working-age population is collapsing, and the sectors that could drive future growth, they're not materializing. Think of it like this. You inherited a mansion, but you're unemployed. You're still wealthy on paper, but every month, you're selling furniture to pay the bills. Eventually, the mansion is empty. And then what? That's Japan. Rich in assets. Broken flow. Here's where it gets darker. A shrinking, aging population doesn't just mean fewer workers. It means lower consumption, lower investment, lower animal spirits. Businesses stop expanding. Banks stop lending. Innovation slows. The whole economy enters a deflationary trap where waiting is more rational than acting. And deflation is poison for a debtor. When prices fall, the real value of debt rises. A country already buried in debt can't afford deflation. But Japan has been fighting deflation for 30 years. It's not a bug, it's the operating system. So here's the math. Productivity is flat, the population is shrinking, and the debt is compounding. You're running faster just to stay in place. And every year, the treadmill speeds up. Now, some economists argue that automation and AI will save Japan. Robots will replace the missing workers. Technology will unlock productivity. Maybe. But Japan has been a tech leader for decades, and productivity still hasn't budged. Turns out, robots are great at building cars, not so great at fixing a broken fiscal model. Let that sink in. The core issue isn't that Japan lacks resources. It's that the economy is built for a country that no longer exists. The tax base, the pension system, the healthcare model, they were all designed for a young, growing population. But Japan is old, and getting older, fast. So here's the question. When your economy is shrinking and your debt is growing, where does the pressure go? It goes to the yen. Currency is the shock absorber. When a country can't grow its way out of debt, can't tax its way out, and can't cut spending without political suicide, the pressure has to go somewhere. In Japan's case, it goes into the exchange rate. Here's how it works. A weak yen makes exports cheaper and more competitive. Japanese cars, electronics, machinery, they all get a price advantage when the yen drops. Sounds good, right? More exports, more revenue, more growth. Problem solved. Except it's not. A weak yen also makes imports expensive. And Japan imports almost everything. Energy, food, raw materials. The country is resource poor and import dependent. When the yen weakens, the cost of living goes up. Heating bills rise. Grocery prices climb. Consumers get squeezed. And remember, Japan's population is old. Retirees on fixed incomes can't absorb price shocks. They just get poorer. So the weak yen isn't a solution. It's a trade-off. You boost exporters at the expense of households. You help corporations and crush consumers. And in a country where domestic demand is already dead, crushing consumers makes the deflation problem worse. Think of it like this. You trying to bail out a sinking boat by scooping water from one side and dumping it on the other. The boat is still sinking. You're just moving the problem around. Here's where it gets uglier. A weaker yen also makes the debt harder to escape. Why? Because investors start to worry. If the currency keeps losing value, foreign buyers won't touch Japanese bonds. Even domestic holders start to get nervous. And if confidence cracks, the BOJ has to step in even harder, buying more bonds, printing more yen, weakening the currency further. It's a doom loop. Weak yen leads to inflation. Inflation forces rate hikes. Rate hikes blow up the debt. So the BOJ holds rates down. Holding rates down weakens the yen. And the cycle starts again. Let that sink in. Now, Japan has tried to manage this for years. The BOJ intervenes in currency markets. The government talks about orderly adjustment, but intervention only works if you have unlimited reserves. Japan's foreign reserves are large, but they're not infinite. And every time the BOJ defends the yen, it burns through dollars it might need later. So the yen becomes a pressure valve. It releases tension in the system. But every release makes the next crisis a little bit closer. Because once the market smells weakness, once traders realize the BOJ is trapped, the selling accelerates. And Japan doesn't control the timing anymore. Here's the kicker. Japan can have a strong yen and a manageable debt load at the same time. A strong yen would crush exports and deepen deflation. A weak yen drives up import costs and erodes savings. There's no win condition, only different flavors of losing. So here's the question. If the math doesn't work, the demographics don't work, and the currency is a ticking time bomb, what are the actual exit options? There are only 3 doors, and they're all bad. Door number 1, inflation. Let prices rise. Let the debt erode in real terms. 100 yen today is worth less tomorrow. Multiply that over years, and the debt becomes more manageable, not because you paid it off, but because you devalued it. It's elegant, it's quiet, and it works. Until it doesn't. Because inflation isn't a scalpel. It's a sledgehammer. You can't just inflate away the debt without crushing savers, retirees, and anyone on a fixed income. Japan's elderly population holds trillions in cash and low-yield assets. Inflation silently robs them. Their purchasing power evaporates. The social contract shatters. And here's the darker part. Once inflation starts, it's hard to stop. Expectations shift. Workers demand higher wages. Businesses raise prices. The spiral feeds itself. And if the BOJ tries to tighten to stop it, rates go up, and we're back to the debt bomb we talked about earlier. So inflation is an exit, but it's an exit through the fire. Door number 2, default. Just stop paying. Restructure the debt. Force bondholders to take a haircut. Admit the math doesn't work and reset the system. Sounds radical, but it's not unprecedented. Countries default all the time. Greece did it. Argentina does it regularly. Russia, Ecuador, Iceland, the list is long. Default isn't the end of the world. It's just the end of the illusion. Here's the problem. Japan isn't Greece. It's a G7 economy. The yen is a reserve currency. Japanese government bonds are considered one of the safest assets on the planet. A default would shatter global confidence. Pension funds, insurance companies, central banks around the world, they all hold Japanese debt. If Japan defaults, the contagion spreads. And domestically? Catastrophe. Japanese banks are loaded with government bonds. A default would wipe out their balance sheets overnight. The financial system collapses. Depositors panic. The real economy seizes up. So default is technically an option, but it's the nuclear option. And Japan knows it. Door number 3, financial repression. This one's sneaky. You don't default, and you don't let inflation run wild. Instead, you trap domestic savers into holding government debt at below-market rates. You cap yields. You regulate where pension funds and insurance companies can invest. You make it illegal, or just really inconvenient, to move money abroad. Essentially, you turn your citizens into captive creditors. You force them to lend to the government at a loss. It's a slow-motion wealth transfer from savers to the state. The beauty of financial repression is that it's invisible. There's no dramatic collapse. No panic, just a gradual erosion of wealth. People don't riot in the streets because they don't see it happening. Their savings just shrink. Slowly, quietly. Japan is already halfway there. The BOJ owns half the bond market. Domestic institutions are heavily regulated. Capital controls aren't explicit, but the system is designed to keep money onshore. Financial repression doesn't require a policy announcement. It just requires inertia. Let that sink in. So those are the 3 doors. Inflate and burn the savers. Default and detonate the system. Or repress and bleed the population slowly. There's no 4th door. There's no miracle fix. And the longer Japan waits, the more violent the eventual exit becomes. Here's the comment bait. If you had to choose, higher inflation that quietly erodes debt, or higher taxes and spending cuts that crash living standards, which poison is less deadly, and why? Drop your answer below. So here's the final question. What does this all mean, and who's next? Here's what it means. Japan's debt miracle was never permanent. It was a temporary alignment of conditions that no longer exist. High savings, low rates, captive buyers, and a patient population. Those conditions are gone. And when the conditions change, the rules change with them. The lesson isn't that Japan did something wrong. The lesson is that every system has a shelf life. Governments, central banks, entire economies, they're built on assumptions. And when those assumptions break, the structure comes down. Japan assumed its people would save forever. They're not. It assumed deflation was manageable. It's not. It assumed the central bank could hold the system together indefinitely. It can't. And here's the warning. Japan isn't unique. It's just early. The same demographic collapse is coming to South Korea, Italy, Germany, and eventually China. The same debt traps. The same impossible choices. Japan is the test case. And the test is failing. The myth was that debt doesn't matter if you owe it to yourself. The reality is that it matters even more. Because when your creditors are your own citizens, the breaking point isn't financial, it's social. It's the moment people realize the system isn't sustainable, that their savings won't hold value, that the promises made won't be kept. And that moment is coming. So what happens next? Probably some version of all 3 exits at once. A little inflation here, a little financial repression there, maybe a technical default disguised as a restructuring. Japan will try to manage the decline, make it gradual, keep it orderly. But economics doesn't care about order. It cares about math. And the math says the runway is ending. This isn't the end of Japan. It's a rich, innovative, resilient country. But it is the end of the debt miracle. And when that miracle ends, the world will have to rewrite the rules about what's possible with sovereign debt. Because if Japan, the country that proved you could run infinite deficits with no consequences, turns out to be wrong, then every government watching has to ask, are we next? In the next video, we'll look at the UK, a rich country discovering that services economy doesn't pay the bills when the middle class starts to snap. It's a different crisis, but the same math. And the same lesson, systems break. Always. If this helped you see the bigger picture, hit the like button and subscribe. We're building a library of how the global economy actually works, not how politicians say it works. Thanks for watching. See you in the next one.